Hello, I'm Edward Sterling, macro analyst for Bulwark Bullion. For many investors, physical gold represents the ultimate safe haven asset. It's tangible, it's outside the financial system, and it has served as a store of value for thousands of years. But there's an important part of the conversation that rarely gets discussed. Owning physical gold comes with real costs. Costs that many investors don't fully appreciate until they're already in the market. These aren't always obvious fees. In many cases, they're hidden in the structure of the physical gold market itself. So today, we're going to break down the hidden costs of owning physical gold and why understanding them is critical for investors. When people first think about buying physical gold, the idea seems simple. You buy gold, you store it, and if the price rises, you sell it. But the real-world mechanics of buying and holding physical gold are a little more complicated, because unlike financial assets like stocks or ETFs, physical gold has friction. That friction shows up in several places: during the purchase, during storage, and again when you eventually sell, and those costs can add up. The biggest cost many investors encounter is the dealer premium. When you buy physical gold, you're almost never paying the exact market price you see quoted for gold. That quoted price, often called the spot price, reflects the value of gold in large wholesale markets. Retail investors, however, buy through dealers, and dealers add a markup. For common gold coins or bars, that markup can range from 2% to 10% or more, depending on market conditions and product demand. In other words, the moment you purchase physical gold, you're often starting a few percentage points below break-even. Gold prices have to rise enough just to offset that initial premium. Then, there's the issue of storage. Unlike digital assets or brokerage accounts, physical gold must be stored somewhere secure. Some investors choose to store gold at home, but that introduces its own risks. Others use bank safe deposit boxes or private vault storage, which often come with annual fees. Those fees might seem small on the surface, but over time they can add up, especially for investors holding gold as a long-term store of value. And if you want the metal insured, that adds another layer of cost. Another hidden cost is liquidity. Selling physical gold isn't always as simple as pressing a button in a brokerage account. You usually need to find a dealer willing to buy the metal. And just as dealers charge a premium when selling gold, they often buy back at a discount to spot price. This difference between the purchase premium and the resale discount creates what's known as a bid-ask spread. That spread represents another friction point in the physical gold market. When you combine all these factors, the economics of physical gold ownership start to look a bit different. The chain reaction works like this. You buy gold from a dealer at a premium above spot price. You may pay storage and insurance costs over time. And when you sell, you may receive a price slightly below the spot market. The result is that gold prices need to rise meaningfully before physical investors see their full return. Before we go further, if you're enjoying this breakdown of the precious metals market, make sure to hit the like button and subscribe to the channel. Despite these costs, physical gold remains extremely popular with investors, and there are reasons for that. Physical gold offers something that financial assets don't. It exists outside the banking system. It carries no counterparty risk. And during periods of financial instability, that independence can become extremely valuable. For some investors, the additional costs are simply the price paid for that level of security. The broader macro environment also helps explain the continued demand for physical gold. Central banks around the world have been accumulating gold reserves at one of the fastest paces in decades. Geopolitical tensions remain elevated. Global debt levels are historically high, and many investors remain concerned about long-term currency stability. In that environment, physical gold continues to serve as a form of financial insurance. But like any insurance, it comes with a cost. For investors considering physical gold, a few factors are worth paying close attention to. First, compare dealer premiums across different products and sellers. Second, consider the storage solution and the long-term cost of holding the metal securely. Third, understand the liquidity process, how easily the gold can be sold, and at what price relative to the spot market. These practical details often matter just as much as the price of gold itself. The key takeaway is that physical gold ownership isn't just about the price of the metal, it's about the structure of the market around that metal. Dealer spreads, storage costs, and liquidity considerations all shape the real return investors ultimately receive. Understanding those hidden costs doesn't mean physical gold is a bad investment. It simply means investors should approach it with clear expectations. If the world enters a period of financial instability where trust in financial systems declines, could the hidden costs of physical gold end up being a small price to pay for owning real, tangible wealth? Thanks for watching. If you're interested in gold, silver, and the macro forces driving global markets, make sure to like the video and subscribe. For more analysis, visit bulwarkbullion.com. I'm Edward Sterling, macro analyst for Bulwark Bullion. See you in the next one.